Managing finances often brings up pressing questions about liquidity, especially when dealing with major financial platforms like Empower. Deciding whether you can pull every single dollar out of your account requires looking closely at the specific type of account you hold with them, because the rules change dramatically depending on whether your funds are sitting in a personal investment portfolio or a locked workplace retirement plan. Empower handles different financial products with distinct rules, mandates, and restrictions. Understanding these mechanics prevents unexpected financial hits, tax liabilities, and administrative delays. Personal wealth management or brokerage accounts operate with high flexibility. If you use Empower for taxable investment portfolios or personal cash management services, you generally maintain full control over your capital. Selling your assets, liquidating your positions, and transferring the entire cash balance back to your linked external bank account remains entirely possible. Processing times for selling securities, clearing trades, and executing an ACH transfer typically span a few business days. While cashing out a taxable brokerage account triggers zero early withdrawal penalties from the platform, keeping capital gains taxes in mind remains crucial since selling appreciated assets realizes taxable income for the year. Retirement accounts follow an entirely different rulebook. Millions of people interact with Empower because their employer uses the platform to administer 401k, 403b, or other defined contribution plans. Attempting to withdraw the entire balance of a workplace retirement plan hits immediate structural barriers. Federal regulations and internal plan rules restrict full cash-outs while actively employed. Generally, tapping into a workplace retirement plan requires experiencing a qualifying life event, such as terminating employment through quitting or retiring, reaching the age of 59 and a half, or proving severe financial hardship. Active employees rarely possess the option to pull a full cash distribution from a current employer plan. Plan administrators enforce these boundaries to protect long-term savings goals. Attempting a total withdrawal while still employed usually results in immediate denial from the platform unless a very specific exception applies, such as a qualified plan loan or an approved hardship withdrawal, which typically restricts funds to specific categories like avoiding eviction or paying urgent medical bills rather than a total account liquidation. Leaving an employer changes the landscape significantly. Departing a company allows full access to manage the accumulated balance, yet choosing a direct cash distribution instead of a strategic move brings heavy financial consequences. Cashing out an entire retirement account before turning 59 and a half triggers a mandatory federal income tax withholding, local state taxes, and an additional 10% early withdrawal penalty from the Internal Revenue Service. Furthermore, a massive lump sum cash distribution pushes total taxable income upward for the year, frequently bumping individuals into higher tax brackets and wiping out a substantial portion of the hard-earned savings. Smart alternatives exist for those leaving a job who want to move money away from Empower without absorbing devastating tax penalties. Executing a direct rollover allows the movement of the entire balance straight into an individual retirement account or a new employer's retirement plan. Direct rollovers maintain the tax-deferred status of the funds, allowing investments to keep growing untouched by the government while bypassing early withdrawal penalties entirely. Individual retirement accounts managed directly through Empower provide another variation. Traditional IRAs and Roth IRAs allow owners to initiate a full distribution or close the account completely at any time. Traditional IRA withdrawals face ordinary income taxes alongside the potential 10% early penalty if taken before age 59 and a half. Roth IRAs treat contributions differently, allowing the withdrawal of principal contributions at any time without taxes or penalties because those dollars used post-tax money originally. Though withdrawing earnings early can still trigger penalties unless specific exceptions are met. Initiating a total withdrawal requires navigating the digital dashboard or contacting customer service directly. For taxable brokerage accounts, navigating to the transfer or withdrawal section, selecting the destination bank, and confirming the liquidation of assets completes the process smoothly. For retirement accounts, downloading distribution paperwork or navigating the online retirement portal requires specifying whether the intent is a direct rollover or a cash payout. with the system calculating required tax withholdings automatically. Evaluating the ultimate goal before clicking confirm on a total account liquidation protects long-term financial security. Consulting a certified tax professional or financial planner before pulling large sums out of tax-advantaged accounts ensures clarity regarding the true cost of a complete cash out.